Hello, and welcome back to the Fintech Takes podcast. Today's episode is a great episode. I know I say that all the time, but this one really, truly is. I was lucky enough to have Dan Murphy, who was a member of the team at the CFPB under Director Chopra in the Biden administration, who worked on and helped create the open banking rule. Dan came on the podcast to break down everything that's been happening in open banking, which obviously I have been writing and podcasting a lot about, but I'm doing that from the outside. I didn't work at the CFPB. I don't know the intricacies of the Administrative Procedures Act and how to actually craft a federal regulatory rule. Dan lived this life. He was right there and knew exactly what went in to the existing rule and has been a very close observer of everything that happened since the CFPB published the final open banking rule in October of last year. We obviously talk about the Bank Policy Institute's lawsuit. We talk about the Trump-era CFPB reversing course and then reversing course again on the open banking rule. We talk about JP Morgan Chase and its pricing gambit and potentially the fact that that gambit might have backfired and it might have put both banks and the CFPB in a difficult position moving forward. So all of that plus a whole bunch more nuanced and nerdy conversation about open banking is next. Here is my conversation with Dan Murphy. Dan, thank you so much for joining me.
Thanks for having me, Alex. It's great to be here.
It is great to have you here. You are the guy I've wanted to have on this podcast since all of this started to happen. And I have a very simple plan that should keep us on track. And the plan is to talk briefly about how we got to where we are right now. And that is actually a very important thing to do because, as we were talking about before we started recording, literally just had some breaking news like 20 minutes ago that impacts some of the things that we're going to be talking about in terms of where open banking is at this exact moment. And then where I want to spend a majority of our time is talking about what happens next and, to a degree, what we think maybe should happen next, whether that's realistic or not. So, Dan, to start us off here, you were working at the CFPB. You were working on this particular rule as a part of the team that was putting that together. Obviously, we know that the rule was finalized in October of last year. For those who maybe haven't been as deeply enmeshed in the regulatory rulemaking process, which I'm guessing for you, you think of that as probably a blessing for those folks rather than a curse. Can you briefly explain how that process worked and specifically for open banking, like what it looked like? How did we get from the very early days of, hey, we should start working on a rule here to actually having that final rule? What does that process look like?
Sure, Alex. And again, just thanks so much for having me. I've been looking forward to coming on to discuss this too. There's obviously been a lot of really interesting discussions and developments in the market in the last couple of months that you've been doing a really great job of tracking. So I think this is a really long saga, and so I'll try to make this as brief as I can. The CFPB has been focused on open banking really for quite a long time. Back in 2016, the CFPB really started to take an interest in this issue. And throughout multiple administrations, there was an increasing and sort of building consensus that some action by the Bureau needed to be taken. And that consensus was held by both administrations of both parties. So under Director Chopra, under Director Kraninger, under Director Cordray. And it was also held by all sides of the market. So banks were saying, hey, really, we need something here. Fintechs were saying, hey, really, we need something here. What that something was has always sort of been, of course, the really hard part of this. But there was broad agreement that something needed to happen. And so under the first Trump administration, the process really kicked off more in earnest when an advance notice of proposed rulemaking, or ANPR, was issued, which generally, as ANPRs tend to do, and this will be relevant later, asked a lot of questions about things they might consider if they were to issue rules in this market. That process accelerated under the Biden administration. Director Chopra, and that's when I came in as well, really started to pick this up and took it, and ran even further. The first thing the CFPB did in that case was issue a SBREFA outline. For those who are luckily uninitiated, SBREFA stands for the Small Business Regulatory Enforcement and Fairness Act. And really what this is an outline that basically scopes out the broad strokes of the proposal for small businesses to consider so they can determine how it might impact their business. Then, as is mandated, the CFPB went through a SBREFA panel process where they brought small businesses of all types, small banks, small fintechs, other types in to really kind of consult and assess on what would this mean for your business? What would the cost be? What's practical, what's not? That's a really involved process that took some time. Then there's a SBREFA report where the CFPB had to summarize all of that. Then the CFPB took more time to think about the proposals in light of all of that. And then there was a proposal, right? And the proposal was the much more detailed sort of, okay, here's, and more specifically, what we're thinking about doing in this space. And there too, public comment is invited. And so we received, I think, more than 11,000 comment letters from all different types of stakeholders.
I remember looking through them, Dan, at the time. I know you had to read like every single freaking one of them, but there was a lot of comments.
There really were. And, I will say that about 200 of them, I think, if I remember correctly, were, closer to unique comments. There was one large public campaign that, counted for a lot of the bulk there. But those 200, I mean, some of them were 50, 60, 70, over 100 pages. So the comments that we got from the public were really, really detailed. And I have to say, really helpful. And, having been outside of government, before I was in it, I think sometimes you have this perception when you write a comment letter where you write the letter, it goes off into the black box, and then you're never really quite sure. I can tell you, we really do read the comments. These agencies are mandated under the APA to read the comments, and they're enormously helpful. The process is there for a reason. And so we, back to the story, we, went through the comments, we made some adjustments to the rule, and then we finalized the rule, as you said, in October of last year. That really brings us up to where we are today, where there's been some pretty interesting legal developments since then, but I won't get ahead of your part of the narrative here.
No, that's exactly what I want to talk about. And thank you for laying out the process for us, because as you said, that's going to become relevant in a second. So to catch us up to the present day, October 2024, the rule is released. Immediately after the rule was finalized, and I mean immediately after, the Bank Policy Institute, which is a trade association that represents big banks in the U.S., sued the CFPB over the rule. Just real quickly, can you kind of summarize for us what the BPI suit argued? And from your vantage point, and obviously this is just you speaking on behalf of you, but what do you think they were trying to get out of that lawsuit? What was sort of the intention behind it, from what you could tell?
Sure. No, I'm happy to share my perspectives. And it is worth noting here that sort of everything I say here really are my perspectives. They're not the perspectives of my former employer, any current clients. These are really just kind of Dan speaking on behalf of Dan. So I think, look, I'm not naive. I think with any kind of rule this complex that touches this many different parties, there was always a high likelihood that somebody somewhere was going to be unhappy enough on something that they may try to sue over it, right? You just can't totally control for that when you have, I mean, look, like I said, there's 11,000 comments. You have an ecosystem this broad of people. I think what I was very surprised by was the fact that the banks decided to sue on such broad and fundamental grounds, literally within hours of the rule coming out. Director Chopra has a funny line that he uses when he's asked about this, which is that for the first couple of days, I think you maybe even were interviewing him, Alex.
He used it with me on stage.
That's right.
At Money 2020.
Yeah. Which is at the time. I
got a big laugh too.
At the time, I think he said, I haven't read their lawsuit, but that's okay because they haven't read our rule, which I think was true. Right. It was demonstrably true. What was surprising about the lawsuit in terms of what it argued was that it argued that the CFPB never even had authority to issue a 1033 rule that contemplated third-party data access, what most of us would think of as open banking. That was a really staggering position. It wasn't a position that BPI took in its comment letter. So that was quite surprising. And it also was a staggering position because, there had been a lot of engagement, as I mentioned, over multiple administrations with industry, including with banks on this. And, everybody had different perspectives. There were lots of things that folks agreed about, disagreed about, but there wasn't that much broad sort of pushback. People seem to implicitly, including BPI, seem to implicitly agree the CFPB has authority to do this. They are going to do it. And so the fact that it challenged the rule on those really fundamental grounds was really surprising. There were another number of other things that were included in the lawsuit. I'm not sure if we want to get into all the different sort of counts. It might not be worth it. One that maybe is worth flagging here, just for purposes of discussion, is that the CFPB had gone too far by prohibiting fees, by prohibiting, what we call data providers, often, banks and credit unions, although it can be fintechs too. To charge fees under the rule. That was one of the counts. And then I guess maybe just to say one more note about the first point, which is this fundamental ground that the CFPB never had authority to do this. That argument was really, at least in my view, sort of premised on reading a number of words out of the statute. The statute, is broadly written, to be sure. Section 1033 is a lot shorter than a lot of other open banking legislation you might see around the world. But the statute does clearly say that consumers include agents, trustees, and representatives. And you don't, look, I don't think you can just read those words out. And that's what the lawsuit seemed to be doing, was trying to say, don't worry about that. Just focus on everything but that. And so I think that's probably an important thing to point out.
I'm glad you pointed that out, because the word that's stuck in my head ever since all this started happening is agents, right? And, from a just sort of basic legal reading, and I'm not a lawyer, so I'm not going to try to go too hard at this point, but just like using sort of basic legal logic, agent has typically broadly been sort of construed as the idea of an authorized third party acting on behalf of a consumer who's authorized them to do something specific. So the word agent in there is important, both from a legal context, but also I think just in recognition of the reality on the ground when Dodd-Frank itself was written, where a lot of this infrastructure and these practices of third parties accessing data on behalf of consumers already existed, right? So it was sort of, I would imagine, also an acknowledgement of just the reality of how open banking, even back then in 2010, was working, right? So you fast forward then, obviously, what happens in November of last year is that Donald Trump is elected president again. As you noted, the rulemaking process really began in an earnest way under Director Kraninger, under the first Trump administration, right? So it's not as if we had a lot of evidence or expectation from the first Trump administration that things were necessarily going to be that different this time around. However, and this is where I'd love you to just comment briefly again, the vote era CFPB has been an experience, and I've written about it in extensive form previously. I've talked to a bunch of people. I know you obviously have some very direct experience and know a lot of folks either at the Bureau today or who've been at the Bureau. It's been quite a shock, right? And I think the reason that that's important, the reason that the sort of vote, I've almost described it as like a performance art piece of like, what would it look like if I took a government agency and just smashed it with a sledgehammer? The reason that that's important is it has sort of involved a full-scale undoing of everything that the CFPB has been up to, both from a staffing perspective. Obviously, we've seen significant attempts to cut back the staffing of the Bureau, the funding of the Bureau, but also like a real reversion or almost like kind of bizarro take on everything that the Bureau had been doing, right? So rolling back rules, rolling back guidance, canceling or settling enforcement actions or suits, like just across the board, anything that was being done under the Biden administration specifically, but even stuff that stretched back before that, we're just going to like reflexively try to undo all of those things. Specific to open banking, that resulted in the vote CFPB taking a very specific stance in the lawsuit with BPI. Can you just catch us up on that one moment? Because that was, I think, to everyone watching, quite a surprise relative to what we might have reasonably assumed would have happened when Donald Trump was elected.
Yeah, no, absolutely. Happy to do that. And I will say, too, I'd be remiss if I didn't also just say that, look, what's happening at the CFPB and across the federal government right now is, in my view, really just kind of an unspeakable tragedy for
Totally.
obviously for the people directly involved. I mean, look, I was in the first wave of people fired at the CFPB.
Yeah.
I know what going through that was like. A lot of my colleagues are still going through it. And so, I think my thoughts and all of our thoughts should be with them. And even for the regulated entities who, look, people tend to beat up on the regulator. I understand it's not always fun to deal with your regulator. I've heard from a number of folks in the last several months that this is really, really challenging for regulated entities as well, because there's just stuff going on in the market. And this might be open banking, or it might be something totally separate. And they have people at the CFPB who they knew to call, and the CFPB plays sort of an umpire role, calling balls and strikes there. And if there's nobody they can call, or if they know, and this is maybe more accurate, that the person they call has no control anymore because the whole agency is effectively on ice, then they really are sitting there without any direction. So you have a real lack of regulatory clarity. So I would have to point out just sort of the unforced error that this is creating for American markets. Now back to what happened on 1033. So, as you mentioned before, BPI filed this lawsuit on these existential grounds. There was a broad expectation, though, I think really among pretty much everybody, that sure, this new CFPB was going to look drastically different than the old CFPB. There were going to be really big changes. But at the same time, people remembered the Mulvaney era. They remembered the Kraninger era. They kind of didn't really think that things like this, where there was broad bipartisan agreements, where there was broad agreement across industry, or at least there used to be, would somehow be turned around. So everybody was really quite surprised when what happened was the CFPB actually agreed with the BPI's stance in court and basically asked the court to vacate the rule on the grounds that BPI was correct. That was a really shocking position for the CFPB to take. It had obviously never taken a position like that before, and maybe more importantly, it had taken very careful, thought out legal positions to the contrary over the prior years through the notice and comment process that I spelled out before. So, Alex, it's really pretty strange to have all this long legal record of your positions on something, and then one day to wake up and just say, hey, I know I've been through all that legal process to come to this place that I landed. This morning I feel differently. It's all the exact opposite, and no, I'm not taking any comments on that position. That's not exactly good governance.
No, and it was really strange, right? I mean, as you outlined, it was a shocking thing for BPI to argue in their lawsuit, right? But you could see it a little bit as just like I read it almost as like you don't even have the authority to do this, like just pissed about it, right? Like that, I mean, my kids say stuff to me all the time that they don't mean, and it kind of felt a little bit like that, where it's like, I hate you, and it's like, okay, well, let's just simmer down a bit. But for then the CFPB, which, as you said, has been over many, many years and over different administrations, sort of carefully staking out a legal argument that, no, we have the authority to do this. This is broadly in scope with what Congress intended under Dodd-Frank, to basically just flip all of that around and say, no, actually, we agree. We don't have the authority to do this. And to ask for the rule to be vacated, which is where that sort of action ended up, was really surprising. So that's sort of twist number 2 in this post-rule saga. I now want to briefly touch on the third twist, which is, no good story is good if you don't have the full trilogy here, right? Sure. So the third story in the trilogy is that a certain large participant, who we don't have to be coy about because it's JP Morgan Chase, which obviously is I would sort of describe them as a principal and probably very influential member of the Bank Policy Institute, which was behind the lawsuit. Essentially, and again, this is my reading of the situation, saw an opportunity after the CFPB took this position to revisit one of the areas that you described that BPI mentioned in its lawsuit, which was a frustration on the part of banks not being able to charge fees for access to data. And Chase exercised a clause in the contracts that it has with data aggregators to inform them that it would be charging fees for access to its APIs. As I've outlined and numerous others have reported on, those fees were both very, very high, as well as differentiated based on use case. So payments use cases, there's a higher fee for than non-payments use cases. This, as anyone could have predicted if we had known this was going to happen, ignited a firestorm of controversy and debate and argument. I think you and I have both been involved in many of those arguments. You actually wrote a great op-ed for Fintech Takes outlining some of the background here. Let me just start here. I'm assuming you were pretty surprised by this particular outcome as well, correct?
I was, in part because immediately, I think for a lot of folks, there were strategic questions that came to mind about the wisdom of doing this on the timeline that they did it. For whatever I may think of it, it seemed as though BPI had sort of successfully pulled the wool over the eyes of the new CFPB leaders for a time. Sure. And CFPB was going along with their legal arguments. And then one of which, as you point out, was related to this issue around fees. And so, based on how that all played out, they could have done this later. The thing that I think was really surprising, though, was just the timing of this. And so the fact that they came out with this, demand in the market for fees when they did really surprised everyone, in particular because as of now, the current final rule is still effective. And the final rule does say no fees. It had not yet been vacated by the court, and as we sit here right now, the final rule is still effective. And so the fact that they came out on that timeline and said, no, actually, we're going to start charging it right now seems pretty premature and overconfident. And in fact, what seems to have happened is it seems to have tipped off the Trump administration and the CFPB that actually the folks that they were dealing with here were maybe not exactly being as forthright as they thought. And so a lot of other types of folks, fintechs, crypto companies, merchants, consumer advocates, a lot of folks who don't always agree on things and actually
not always on the same side of the ball. Yeah.
No, and quite often strongly disagree on things. Really sort of, threw a red flag here and said, no. This cannot go on. This is absolutely anti-competitive. This is a problem. Yeah. And so that was really the surprising thing that's happened most recently. And as you're alluding to, I think too, that also caused the CFPB to reverse course yet again and say, and this is where we are today. Nope. Yeah. Actually, what we're going to do is we're telling the court that we don't want to vacate it anymore. We want the lawsuit to be set aside while we work on a new rule. But the subtext for that is that the current final rule still stands and still says no fees for data access. So that's where we are today.
So a couple of things to emphasize on that. One, it is hilarious and embarrassing to go, yeah, you know what? We don't have the authority to do this. This is crazy. Like, we should just set the rule aside. To then go, no, JK, we do have the authority to do this. Like, I don't know how you go back to the court. And I can't remember the exact language they used in their filing. It was something like based on recent market developments, something like that. And basically argue, no, actually, we do have the statutory authority to do it. Like, that was what made them agreeing with that argument made by BPI so shocking before, when they were seeking to have the rule vacated. Is like, it legally, and just from like a logic standpoint, it didn't really leave them with a lot of wiggle room to then change their mind in the future. Like, no, actually, we do have the authority under 1033 to do this. And yet that is exactly what they did.
With
and
no
to your point, with no explanation. And, we could get into a broader conversation about our justice system and our courts and their sort of humoring of bad arguments, but we won't go there. Suffice it to say that the court in this case agreed with the CFPB that, okay, now if I think from the court's perspective, they're like, look, you're the one doing all this. So you just tell us what you want to do and you do it. So now where we are today is the court has agreed to a stay. so that the Bureau can go through what it is described as an accelerated rulemaking process, right? And this brings us to what's going to happen next. So a couple things that you hit on that I want to follow up on. One is the whole sort of idea that Chase might have overplayed its hand, or at least played its hand with bad timing here, right? Because as you said, the rule, from all intents and purposes, from everything we could tell, seemed to be on its way to being vacated by the court, right? Because again, the court is just like, okay, the CFPB is the one who did this. If they say the rule should be tossed out, like maybe we'll just toss out the rule. Like that seemed to be directionally where we were headed. Instead of waiting for that outcome, Chase decided to take this approach. Instead of taking the approach of opening up a conversation about fees in a more reasonable way, Chase took the approach, which I have described before as sort of walking into a BMW dealership and saying, I'd like to buy a brand new BMW for $1, which is just a very aggressive opening stance to take that is going to elicit strong feelings with the parties that you're negotiating with. And as you outlined, it really activated not just the data aggregator community, which is the obvious sort of stand-in for fintech, and I think was kind of in some ways the representative of fintech companies in standard setting through FTX, in a lot of the commentary going through rules. Like a lot of, fintech's side of this was really kind of articulated through the data aggregators, which I've actually argued in the past was maybe not a good choice on the part of fintech companies because sometimes their interests might not be totally aligned. But that's what was happening. When Chase did this, it really got a whole bunch of other folks off the sidelines, right? It got fintech companies directly engaged in the process. And as you outlined before, it also got crypto companies engaged with. Anyone who knows about this current administration knows that the crypto community has a great deal of influence with this Trump White House. So all of that resulted in us going into this, I guess, quote unquote, accelerated rulemaking process. Dan, and this ties into some breaking news, what is that accelerated rulemaking process going to look like, do you think?
Sure. So what the CFPB has said, I think, publicly on this is that when this all happened a couple of weeks ago, they said they were going to issue a new ANPR, again, that's an advance notice of proposed rulemaking, within 3 weeks. I think as of now, we're expecting that pretty much any day. It could come while we're on the podcast here. It could come next week.
It probably will come while we're on the podcast. It
probably will, right? Yeah. It also could get delayed, right? Like these things can get held up among regulators. Like there's all sorts of reasons.
Sure.
And then I think what I've been hearing, from some folks who've spoken to the CFPB, although I haven't, is that there's some interest in trying to move forward on this process within 12 to 18 months. Now, based on my having lived through that process, I can tell you that is incredibly ambitious. I think realistically, you're looking at least 2 to 3 years, but you're really depending on how this goes, it could be longer. And then there's been some other intervening things that could really affect this as well. Probably most notably, as we all know, the CFPB has expressed significant interest in broad scale reductions in force that would fire the very people they need to do this type of work.
Yeah,
that could certainly slow things down. So that's one thing. Another thing is, and this is what you were alluding to, I think there was just some news today, and I actually haven't seen the new unified agenda because it looks like the website is down as I sit here, but I'm told that the new unified agenda said that there would be a new NPRM, which is the notice of proposed rulemaking, in December. If that's true, and again, I haven't seen the document, the website went down, so it's possible that was misquoted to me by someone. If that's true, that would seem to indicate that the CFPB thinks they can somehow evade their obligations under SBREFA to check on the impact that any new rule would have on small businesses.
It would not give the time necessary to do that. Like there just wouldn't physically be enough time. Yeah.
Well, and also they seem to have, if what the unified agenda says is what I'm told it said, then they seem to have basically said they're not doing it by skipping to the next step in the process. Look, I'm not an APA lawyer either, but given my understanding, I think that is probably not permissible as far as I understand, because even if they were to exclude small banks from any new rule, there are so many small third parties that connect to open banking data. So any small fintech out there, for small fintechs, this was the part of the process where their voice was really able to be heard, by itself. So this wasn't really the part of the process that was made for the large aggregators or the large banks. This was made for the small banks, the small fintechs, to really come in and advocate for their position. That's the part of the process that it sounds like the CFPB thinks they are going to skip right now. As an optical matter and as a legal matter, I would advise them against that, but they're going to have to make their own mistakes here. I think the other thing that would imply, even putting that aside, is that between whenever the comment period ends for this new ANPR, which I guess it'll be sometime early to mid-fall, I guess, and December, the CFPB is going to have completed if you, depending on what you believe, either a full rewrite of the 1033 rule or tweaks to the 1033 rule. I suppose it's possible if they're making extremely minor tweaks for them to do something within a couple months. It's still, there's really no part of this rule that's easy to change, though. So even there, I'm quite skeptical. But if they're thinking anything more ambitious, and in particular, if they're thinking about weighing in on this issue related to fees, some of the other issues that were raised in the BPI lawsuit, those are not easy issues. They are not going to be able to do that in 2 or 3 months, whatever it is that they seem to be giving themselves. So I think I have a lot of questions, and I would even say doubt that the public stance of what the CFPB is taking right now about what they're going to be doing is in any way credible.
That makes sense to me, and I would agree with that. So just a couple of points there. On the procedural stuff, it's hard to square, right? Because, they say accelerated rulemaking process. Well, what does that mean, right? Like, if you're accelerating the rulemaking process, the only two things I can think about, just logically, about how that would work is we're either going to throw more resources at it so we can do the regular process faster, which doesn't square with the fact that the CFPB has stripped back resources at every turn, both staffing, which it sounds like the RIFs that were sort of paused may potentially be moving forward, as well as, just like money coming in, which both Director Vogt and Republicans in Congress have been working to basically cut back. There's just no real way to throw more resources at it. So then the other way to do accelerated rulemaking would be to skip steps in the rulemaking process. And that seems more ideologically consistent with what we've seen from this administration, just in the sense that, like, not just in financial services, but sort of across the board, there doesn't seem to be a lot of reverence for the Administrative Procedures Act, which, no one likes, but exists for reasons and is the law of the land. So I could see that being more plausible. And that kind of goes to support your idea that that the unified agenda, as it's been communicated to you, that at least seems ideologically consistent with, we don't need to do these parts. But to your point, just from an optics perspective, cutting the small banks and small fintech companies sort of out of the loop of the process relative to the big data aggregators and to Chase and others who clearly have already had their voices heard by the CFPB isn't the greatest look in the world for any administration. So the procedural questions are all kind of interesting. The other thing I wanted to ask you about before we get into actually how might the rule change itself is, during that process that you just described, how does that overlap with what we might see in the market, right? Because as you said before, the rule itself is in place still. It has not been vacated. It doesn't seem like it's going to be. As of right now, we're still marching towards the compliance deadlines that we're going to go into effect next year. There are components of the rule that are obviously in effect right now that it's been finalized. And I guess just generally, it seems to me like a big motivating factor that Chase had when it kind of undertook its pricing gambit was that it sort of felt like there was a void of sort of just attention being paid here, right? And I've always kind of felt like, even in the absence of rules that are in force, the whole cop on the beat thing is a real thing in the industry, right? In the sense that, if you play this out in sort of an alternate universe and say Kamala Harris wins and Rohit Chopra finishes out his term as director of the CFPB, I just don't think Chase is doing this, right? Even if like they technically might have had the ability to do it, or they could have made the argument that they did or whatever, like they're just not doing that under that alternate scenario. So now that we're in this place of accelerated rulemaking is happening, what do you think is going to happen on the market side?
Yeah. And I mean, look, this is the hardest question to answer, right, Alex? Because things are really changing as we sit here. I mean, I would say just on that last point, though, I think you're right. I think Chase would probably have thought quite a bit more about it if it were the CFPB as it previously existed and those of us who were still there. It doesn't seem to have panned out any better for them thus far, though, doing it under this administration. It really looks like they've just antagonized the Trump administration that, for other unrelated reasons we don't have to get into, seems to have some hurt feelings about Chase in general. And so it doesn't seem like this is the wisest move. I'm not quite sure what's going to happen in the market from here. And I would actually say that really hinges on the behavior of the other banks, not named Chase and maybe not named PNC, that although PNC hasn't actually done anything, they've really said
they've just expressed admiration watching the other penguin jump off the iceberg. Yeah, that's right.
And so I think this really comes down to what the other banks do, not necessarily what their trades do, because I sense a disconnect there. But the other banks, I think many of them were surprised and not on board with both the BPI lawsuit and Chase's actions on fees. As far as I understand, at least. I think there's probably a great deal of frustration with JP Morgan Chase's actions. And look, I sympathize with the folks at the banks, including the large banks, and including a lot of the folks at JP Morgan Chase, who spent years and years and years engaging on this, building to it, engaging in FTX, a standard setting organization. There's actually someone running that organization from JP Morgan now, engaging. There is the amount of time and effort and money and real expertise lent to this work by the banks over years and years is considerable. And so there's, I was on a podcast earlier today and I was a little worried that we might have sounded a bit like we were beating up on the banks too much because of the actions of JP Morgan. JP Morgan is JP Morgan. They don't speak for Bank of America. They don't speak for Wells Fargo. They don't speak for Citizens. They don't speak for other banks. And so I think it's really going to be up to other banks to decide what happens in the market now. Do they decide to keep letting JP Morgan speak for them and direct their strategy, even if that strategy seems to be really, really not going very well? Or do they decide to kind of go back to the posture that they had held for years before everything changed and say, no, we understand that the law says what the law says. They may have different feelings on open banking, but they understand that they can't avoid it forever. And they've been working through FTX and other organizations to cooperate with fintechs. A lot of them have really great relationships, both at institutional levels and in between the people who work at them. I hope that's what they do. But it's unclear to me right now what those other banks are thinking.
Yeah, it's a great point. And, I will say that, again, this idea of relationships really matters here, right? And FTX is probably the clearest example of this, although there's lots of others. But like FTX was essentially just a room where bankers and fintech folks and data aggregator folks all sat in a room and kind of talked about, all right, how do we make this work best for everyone? And we're not going to agree on everything. I know for a fact that FTX set aside a lot of big fights that they sort of considered outside the scope of technical standards. But even with technical standards, like how are we going to do this? Door A, door B, how do we figure this out? As you said, the first CEO of FTX who was appointed last year is a former Chase executive, right? So like it was a very like integrated group kind of marching towards a specific vision. And I can tell you, having spoken to a lot of folks involved in FTX, a lot of them, including from the banks, felt blindsided by everything that's happened, right? BPI lawsuit, the CFPB trying to throw out the rule, Chase's pricing gambit, the CFPB reversing course. Like I've really actually felt very bad for the people who've been in the trenches trying to work on making this work and trying to forge consensus, which is hard enough under normal circumstances. And this has been far from normal. So I think that you make a really good point about that. I will be curious to see with Chase specifically how they try to navigate this next little window of time. And, they've actually been pretty public about a lot of this stuff. They've been publishing op-eds. They've been doing stuff to try to communicate. Yeah, running ads in DC, like they've been doing a lot of this stuff. And so I think that, do they just go quiet? Do they try to do more stuff behind the scenes? Did they try to do more stuff through a trade association, which might now be feeling some pressure from other members who don't necessarily like what's happening? So there's a lot of interesting kind of back and forth there. I want to wrap up by talking about what's going to change. And I want to break this into two parts. What do we think might change? And then more on a normative level, if we were just trying to sit down from scratch, absent any statutes or anything, and design sort of a system that would make this market work the best, how would we design it? So let's set the normative stuff aside for a moment and talk practically about what we think is maybe being discussed. I mean, I'm going to give you a list, and I would like you to both add to this list with anything I miss, and then also kind of comment on these different areas. We know pricing is being discussed, right? It's been reported that even in the initial discussions that the CFPB is having with stakeholders, they are signaling at least an openness to looking at pricing and the ability for data providers to charge for access to the data. Another area that the banks and Chase specifically has spent a lot of time harping on is liability, right? And how do we manage essentially liability for when the consumer ends up getting hurt, when there's a dispute, when there's any kind of problem that happens in the way that their data is used? Who is liable for that? And what liability frameworks apply? Obviously, for payment use cases, this is particularly relevant because we already know that big banks don't like being held liable for things that they don't think are their fault under Reg E or some of the existing regulation there. And then, the other two areas that I think are more kind of fintech bugaboos with the existing rule that also might get revisited are the scope of the data that's covered, right? And a lot of fintech companies and data aggregators argued during the comment period that the rule should encompass a lot of different types of data, not just deposit accounts and credit card accounts, but like lots of other things, installment loans, wealth management, payroll, any number of different areas. And then finally, secondary data use, which is an area that Chase has made very clear in their comments that they are concerned about, that they don't like, that they believe data aggregators are abusing, not on behalf of consumers or even necessarily their fintech customers. And that, the Chopra era, CFPB, really took a pretty hard line stance on in terms of restricting secondary use of the data that the consumer authorizes. So to me, those are kind of the big four that are kind of rattling around in my head. What do you think about that list? Would you add anything to that?
I think that's a good list in terms of the types of things they're going to come up on. Maybe two high-level thoughts, and then I'll take maybe each one in turn.
That'd be great.
So high-level thought one is, it is not possible in the course of this rulemaking or working on this topic to make everyone happy. And the CFPB really, really, really needs to understand that. And the more quickly they understand it, the better off they're going to be, because it's just not possible. Anything that you do to make the banks happy is very likely to make the fintechs unhappy. And anything you do to make the fintechs happy is very likely to make the banks unhappy. So you're going to end up in this place where you're going to have everybody being a little mad at you for something. Or if you mess up, you're going to have one side mad at you for everything and the other side happy with you for everything, which means you didn't do it right. And so I think that's something that we need to first appreciate. The second thing is another sort of principle that is probably worth keeping in mind here, that there's been a lot of inconsistencies with the new administration, but one thing that they do talk about a lot, and I think seem to care about, is hewing closely to what is the federal government hewing closely to the statutory authorities given to them by Congress. And so they want to really go back to the statute. They want to go back to what did the law say? And if an agency has gone way beyond that and sort of interpreted, all these things that really weren't, contemplated by the statute, that doesn't really seem in line with what this CFPB and this administration in general think is appropriate.
And that's the vote perspective really distilled down, right? Is this idea that like bureaucracy run amok is the problem we're trying to solve?
Well, and this is where it's a good question, Alex. So it's the vote perspective, certainly, and that's definitely something that we've seen pretty, consistently, I guess. But even before vote, this is actually the product of a long-running, really Federalist Society project to tear down the administrative state. If anyone's paid attention to the West Virginia v. EPA decision, to the Loper-Bright decision, to the Corner Post decision, there are all of these decisions that have happened to chip away at agencies' ability to exercise discretion. And so really now, after those three decisions, the agencies are left looking much more closely at the statute and much more tightly constrained on the types of ways that they can exercise their discretion, which, look, I'll say is not always a good thing, even for those who are really maybe like strict constructionists. Like, you need experts looking at things to make it all make sense, right? Like a congressional staffer with a million things across multiple verticals on their plate is not going to be able to anticipate everything that comes up. Yeah. So those are two things worth keeping in mind. So getting back to your topics, so fees is obviously sort of the big topic du jour. On fees, I think they are in a tough spot, they being the CFPB, because there, as far as I understand, there are sort of four things the CFPB can do. The first thing that the CFPB can do in the course of a new rule is they can try to say, well, they can really just sort of delete the fees language that we had in the old rule and just be silent. But I think JP Morgan has taken that option effectively off the table for the CFPB by doing
it's what scary
they've done.
Like if we just don't weigh in on this at all, that's basically what they are reacting to by not wanting to vacate the rule anymore, right? It's like, if we let the market decide this stuff, this is what that looks like, and it's not great.
Yeah, certainly. And look, if you had asked me this question before the JP Morgan news, I would have said that's where they're going to land. And I would have said it with a high degree of confidence, just sort of knowing, like, the types of arguments they're going to come up against. In this world, where they've explicitly said we're revisiting the rule due to market developments, i.e. JP Morgan's fees, I don't think they can be silent, because silence is just an invitation for JP Morgan to go on and impose fees on everybody, which is going to upset all the same fintech and crypto and other advocates that they've been dealing with lately.
Yeah, Tyler Winklevoss will tweet again if they're not careful.
They're going to have those folks screaming at them again if they do that. But actually, it would be worse in that case, because there wouldn't be a standing rule in the books. So that's one thing I think that's off the table. The other thing is some form of government price setting, which, if you're any kind of free market, type, and look, I'm not the most conservative guy. I don't think government is really the best place to be doing price setting. At the same time, there's two options for them here, I think. The first option is they could say fees, no higher than X are allowed. And the second option is they could say reasonable fees are allowed, or something like reasonable. In either case, they either have to determine X, or they later, through the supervision and enforcement process, have to determine what reasonable means, which gets them back to the determining X problem. So then what? Like, the CFPB is going to go through this really involved market monitoring discovery of price to then set a price in a market. That just sounds like the least Republican thing I've ever even thought of. And so I just don't see how the CFPB could do that. So I don't think any of these options are particularly palatable. The most palatable option, and this is counterintuitive, and others might not agree with me on this, is to simply leave what the current final rule has done on fees in place. Because the current final rule takes care of the very problem that the CFPB has said they're reopening the rule to address. I'm sure they're going to ask questions in the ANPR about this, but they are under no obligation to change that final rule. When it comes to NPRM time, which, if you believe them, will be December, they could just pass on that and go on to address other issues.
So just to be clear on that point, one approach you could take, because you're sort of solving a political problem, right? Like, I have all these people yelling at me, and to your point, like, it's time to get on board with the fact that no one's going to be super happy going through this. Like, you can't make everyone happy. So, kind of wrap your head around that. But to the extent that you can try to, like, horse trade and try to, like, address different concerns, one model, which it sounds like under the rule and just practically speaking might be easier, would be, we're not going to give the banks what they want on pricing, but we might address other areas where we feel like we have more wiggle room that could make banks feel better and make maybe fintech companies and data aggregators feel worse. So that might be theoretically a path forward.
Theoretically, I think that's possible. And then the question becomes, what are those areas, right? And so just to go in order of the other areas that you mentioned before.
Yeah.
So you mentioned liability, right?
Mm-hmm.
Look, I think this really starts to get back to the statutory, like hewing close to the statute issue. And Section 1033 doesn't say anything about liability allocation.
Right.
Open banking regulations, or rather legislation around the world, do say things about liability allocation. In many cases, because the underlying legislation, this is a technical detail, contemplates not only read access, but also write access. That's not what Section 1033 contemplates. And so there aren't the same type of liability considerations in the US as there are in other jurisdictions here. But they're immediately going to run up against that problem and say, okay, so we want to allocate liability in this market under what authority? Now, the CFPB does have authority under EFTA, and so I think what this nets out to is banks, also under TILA, banks could ask the CFPB to, reopen Reg E and Reg Z and sort of try to do something special there for them. I think that is its own sort of can of worms. Both of them are. That is very unlikely. And I think, especially given the resource constraints of CFPB, it sounds like it might find itself under. I'm skeptical they would want to do that once they really sit down and think about it. But maybe I'm wrong. Maybe they think they have a new take on this that they'll try. Count me skeptical.
Sure.
Yeah. Your third was, remind me, Alex, what was your third?
Data, breadth of data.
Breadth of data. So this is one where I think there may be interest of the new CFPB. I don't know, for expanding this. Again, back to the statutory interpretation question. The statute is written more broadly than Reg E and Reg Z. They could easily say, well, okay, we actually want to be closer to the statute. And so that means we have to expand it now to include auto, to include student loans, to include mortgages. There are challenges to doing those things, right? Like there are, you get new small entities in the mix, new non-banks in the mix. Like there's a lot of different challenges that you might rub up against. That's something that I think the fintech community is very supportive of. Yeah. But to your point earlier, it's not something I think that would make the banks particularly happy. So it doesn't really help them with the political horse trading point that you mentioned.
It doesn't. Although I will say one of the things that's interesting, a thought that literally just occurred to me. But again, it kind of speaks to the psychology here. Banks have really struck me on all the open banking stuff. And I'm speaking broadly, right? There are exceptions to this, but just broadly speaking, banks have this very stick your fingers in your ear and go la 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 la, not listening sort of approach to open banking that I think is actually really counterproductive to their goals, because the installment lending is a good example. There's a lot of categories of installment lending where banks actually aren't as big a market participant as others are, right? Mortgage, it's mostly non-bank originators that are originating most mortgages. Auto lending, there's a lot of very large specialty auto finance companies that dominate large chunks of indirect auto lending. Even unsecured personal lending, fintech companies have eaten tremendously into that space, right? And so one of the things that I think you could think, if you were thinking in a more sort of progressive, forward-looking fashion, if you were a bank, is, maybe we should use this as an opportunity to get access to data we want that we're not the net losers of in terms of giving out data, and use it as an opportunity to try to find some of those things. And you could use mortgage as an example of that. You could use auto as an example of that. You could use payroll, which is data that the banks don't have. And I don't think the payroll providers are necessarily super thrilled about the idea of being looped into this, but that came up in the comment period the last time we were doing this. Why not push for some of those things? Am I being way too crazy in terms of strategic thinking on behalf of banks here? What's your reaction to that?
I think my reaction is that, and especially even more so now maybe than last year before the final rule was released, was that I think because at that point I thought banks were sort of starting to turn the corner and think a little bit more offensively, to your point about this, right? Yeah. I think they're back to thinking defensively. And again, when I say they, it's not fair to characterize all the banks by the actions of JP Morgan. to the extent that those are the perspectives ruling the day and sort of being carried by the trade groups, if they're just thinking defensively and they see the Trump administration maybe as an easy marks that may let them get away with a once in a lifetime opportunity to just sort of say no to everything and go on their merry way, then that's the only way I can sort of rationalize the recent actions. But look, I spent a lot of time talking to folks at banks, trying to sort of explain the possible competitive benefits of open banking. And I think I really came across some bankers who really did understand that.
Totally.
Actually,
I've talked to them too. Yeah,
and they get it, but they're outnumbered in general, I would say, by folks who are just sort of like, oh no, not another compliance obligation. Please don't make
reflexively, like this is bad. So, all right. So then I think that's right. So unfortunately, I think that's correct. So then the last one, and again, we haven't really found the thing that we can horse trade on politically yet, because if fees are sort of challenging to do, as you outlined, we're not quite to the point where we've gotten to be able to horse trade. The last one I mentioned is secondary data, and the problem I think there is that I commented on this at the time. The Chopra CFPB did not move at all, almost, on secondary data. Like, it was one of the, and you're going to push back on this because you were on that side of it. You guys got a ton of comments and a ton of feedback on it. I know you read and listened to and considered all of that feedback, but it did seem to me, and I'd love your reaction to this, that the rule expressed maybe one of the places where there was sort of a philosophical opinion kind of coming from the Biden administration and coming from Director Chopra. Like, we don't want expansive secondary data use. We'll have some exceptions to that for fraud and for a number of other areas, but I don't think fintech companies got nearly as much as they wanted as it relates to secondary data in the final rule, which, again, if we're revisiting these areas, that's an area where banks could lose ground relative to picking up ground. What do you think about that?
Well, so again, here, the CFPB finds itself in a tough position, sort of thanks to the arguments advanced by BPI. So you're right. The fintechs did not get what they wanted out of this piece of the rule. And I fully expect that this is something that they would pick back up in any new sort of rule process to advocate for more expansive reading on. What the CFPB said in the prior administration was basically that these uses had to be very limited. And to the point that you made really at the top of the podcast about this all being about an authorized third party acting on behalf of a consumer, that is really the rationale for why secondary uses were limited. And this actually, ironically, very much gets to Chase's points and their arguments with respect to the meaning of consumer and the representative, agent, or trustee of a consumer. The final rule took great pains, and there's a lot of context. I would point you to the preamble to read about all the thought that was put into that. And really, I think the CFPB thought that was very meaningful. That these folks, these whether it's an aggregator or a third party, has to be the consumer's representative at the very least, right? What does that mean? It means they have to be acting on behalf of the consumer. And then what does that mean? Okay, that means that there are probably certain uses of data that if it were just, you going onto a website and poking around and there's not really much of a relationship there, it's much more arm's length, that would maybe be allowable. Maybe they would take your data and use it elsewhere. We both, or others may disagree with that. But in this case, that's not what's going on. In this case, the authorized third party is the consumer's representative. And so there were very strong protections in the rule for that in subpart D. So if the CFPB, back to your point, decided that it wanted to expand those protections, well, that would maybe make the banks happy. Although I'm not certain, to be honest, it would make the banks happy, because I think the banks, and again, when I say the banks, I really mean BPI and Chase, I think this was much more about just shutting things down than about a real concern about subpart D.
Right. But if you took their arguments to at face value, they spent a lot of time really articulating look, our API is being misused, essentially is how they describe it. And, I tend to fall on your side of the argument in terms of I don't know that argument was being made in good faith at all times. But I guess one of the things I'm struggling with a little bit is, the rule is pretty stringent on secondary data use. Right? I mean, to your point about these protections, like the authorization from the consumer needs to be specific to like what they're asking to do. The data that you get needs to be specific to that use case. The authorization expires. It doesn't just continue on in perpetuity. The consumer has to be given really clear ways to revoke or to understand the authorizations that they've been given. Like I felt like of all the parts of the rule, secondary data use, authorization, all those things, that was like by far the most prescriptive that the rule got in a lot of places. Was like, we are really going to try to define how this agent relationship and this authorization and this permission structure works. And to your point, like the data aggregators, they wanted to be able to treat this data, and this is just a business imperative. I don't blame them for wanting to go in this direction, but like they wanted the same rights that like credit bureaus have, right? To like get the data, to use the data in other ways, to productize the data in other ways. Like that's a very natural commercial interest. And that's not what the rule does.
Yeah, it's not what the rule does. And I think, it doesn't leave the CFPB with an easy answer at this juncture, because they can expand, and they can expand they can put more stringent restrictions on what third parties can do with the data. That's going to upset third parties. I'm a little skeptical it would be the first instinct of an administration like this to do something like that. That is to get even more prescriptive than the Rohit Chopra CFPB was.
Right. Well, because you're skating further away from what the statute authorizes you explicitly to do.
Well, and I mean, like, you can reasonably debate that, I think, but I think it doesn't sound like the type of thing that I would expect a Republican administration to do. Right. But then if they decide, okay, no, we're going to actually expand even more, like, okay, no, fintechs, like we thought the Chopra folks went too far, we're going to let you do even more. Well, that just exacerbates the bank's arguments if you take them at face value, right? And it exacerbates what they're upset about. So I really think that BPI and Chase have put not just their side of the industry, but the CFPB into a tough spot here. And they've done it in a way where ultimately I think they may be the net losers, because they've really backed themselves and the Bureau into a corner. And now I'm not sure if the Bureau can get themselves or these entities out of it.
Yeah, I mean, just to put a final capper on that point, I agree with you. And I think the thing that the banks, and again, we're saying banks, mostly we mean BPI and Chase, they sort of, I think, lost track of reality a bit, which is that the rule actually gave them a lot of what they wanted. And the things that it didn't give as much ground on as they wanted are really technically, legally, administratively difficult to give more ground on, right? So to the point we're making, even if they don't give ground on fees, and even if they want to do a little political horse trading and give the banks something in exchange for not giving ground on fees, I mean, I don't know. Is there something we haven't talked about where they can like give banks an easy win? I'm not seeing it.
I don't think there's any easy wins here. And I think this gets back to my first point, because any win that you extract for one group, you're going to necessarily upset the other group. And importantly, it might not be best for the market or for consumers, right? And so I think that's the other thing, is that like we're all talking about this as horse trading, between these two sides of industry, which isn't an unreasonable way to think about the dynamic. But the CFPB's mandate is to care about, ensuring that markets for consumer financial products and services are fair, transparent, and competitive. And so any horse trading that they do, it might just upset the other side of the market, but it also really might cut against their statutory obligations, all of which could, and again, if you throw some APA violations into the mix, all of which can just land them right back in court in a couple of years when they're done with this thing.
I was going to say, I mean, that's the real challenge, right? Especially in a Loper Bright world, we just, and Connor Post and all the rest, like it seems the path forward to getting a new rule that addresses concerns and makes stakeholders happier than they are now, or less upset than they are now, and doesn't open yourself up to just endless legal challenge. Like I just described a set of constraints that maybe the path forward is zero. Like I can't really think of a way to do that just based on all the discussions we've had today. I want to build off of your last point, though, because the last thing I want to ask you about before I let you go is normatively how we should think about this, because all of this is an artifact of a rather vague statute written before this sort of like deconstruction of the administrative state that really unhelpfully doesn't contemplate a lot of specific problems that we're now trying to wrestle with. If we could jump in a time machine and go back and rewrite 1033 and benefit from the lessons that all of these other countries that have implemented open banking have learned. What are some just kind of off the top thoughts you have on areas where, if we were just thinking about it in terms of what's best for consumers and what makes the market work best, are areas that you think are important to kind of consider?
Sure. So I think, first of all, I would say, just again, I can't help but think practically. It's just the way that I'm wired. The folks who were writing Section 1033, I mean, they were dealing with the fallout from the financial crisis. And so I don't really fault
They
them.
had some other stuff on their mind. It's kind of a miracle this was in there at all.
It really is. And like, it's like, I really don't fault them. And in fact, I give them a lot of credit for even remembering to put this in, just given the fact that the mortgage market was booming. Yeah.
Open banking too. We got to jam that in. No, that's 100% true.
Yeah. So I think that's important to just recognize right off the top. I think, look, a lot of the questions that we're debating right now, where congressional, intent, might be unclear or something. Sure, it would be happy if it would have been helpful if they had taken more time and been able to just sort of more carefully articulate exactly what they meant, just to eliminate any doubt, right? I mean, I've heard some folks, for example, on liability, saying, "Well, why can't the CFPB just do something like what the Durbin Amendment does?" Like, well, the answer is because the Durbin Amendment is an amendment, right? It's a statutory instruction, and there is there's nothing like that for the CFPB to follow to sort of address any liability concerns that so it's just not. I think if you did want to address some of those issues, those would be the types of things. I think the two things that come to mind for me, and these are maybe higher level than you're asking about, but I'll share them anyway, are one, the thing that I like about open banking in this whole space in a lot of ways isn't really just like, oh, I love fintechs, or oh, I like, or anything like that. It's much more, there are so many places in the digital economy where your exchange with the digital economy is that you use some product or service, and that product or service uses your engagement with it to extract value from you, show you ads, do other things with your data that really aren't in your interest so that they can get value. And at some point, it really stops serving you, right? And this gets to the whole debate about incentivization and everything. But there's so many places like that in the digital economy right now. Open banking really isn't like that. The whole construct of open banking and this idea of acting on behalf of the consumer is like, no. This is your information. You have rights to that information, and the use of that information should primarily benefit you. And so I would say that's one thing that was sort of gotten right here, and I think is a useful North Star for all of us to keep in mind as we think about this. Another thing I would say is just that this word rights is really important in the open banking debate, and starts to, I think, bleed into the four areas that we talked about before. If you think about open banking as sort of an extension of, or maybe a subsection of, this broader idea, normative idea, that consumers should have rights over their information, their data, how it's used, what entities can do with it, then I think it's really important to really recognize this, again, isn't like the normal value exchange on the internet. But also, it's probably important to recognize that data sharing and data portability and open banking are great, but we shouldn't have too much path dependency here. One thing that was very different in the US context than other open banking regimes was that we didn't have a national data privacy law to work from and refer back to as we were writing this. The fact that Congress hasn't passed a national data privacy law is a huge failing, and something that I do still think needs to be done. And so if we really want to talk about consumer data rights, there's a lot more that needs to be done. I would also note that not only do I think we need new laws on that front, or updated laws on that front, I think we probably are getting close to what I would almost call a CFPB moment for the digital economy, where you might need a new regulator who specializes in all of this, because you have folks like the CFPB and the FTC and DOJ and others addressing digital economy issues piecemeal. But you don't have anyone whose job it is in a centralized fashion to do this and do it well, which is the exact same problem that led to the creation of the CFPB after the financial crisis, because it was nobody's job to look out for consumers, right? And so I think that's one thing that, if you gave me sort of a magic wand to create the universe that I would like to see, I'd like to see a dedicated regulatory body focused on these types of issues. And I think lastly, I'll just say, to get back into the nitty gritty, is this issue around rights, and the statute does say consumer rights to access information, and other open banking ecosystems around the world are also sort of articulated in the language of rights, starts to cut against a lot of those four issues that you talked about too, and it cuts against easy answers to those. So if a consumer's right is only pursuant to a private entity's fee, then it's not really a right, is it? And so that's one thought I think the CFPB probably needs to be pretty careful about as they seek to make adjustments here.
Yeah, no, I think all those areas you outlined are great. I mean, you can't really read the recent history of open banking in the US outside of the context of that lack of a national privacy law, right? Because my sense was always that like a harder stance on secondary data use, as just one example, was sort of a function of, look, we have to hold the line here a little bit more relative to what we might ordinarily do because we don't have a national privacy law. I see things like, reporting that says Delta is going to start doing algorithmic pricing, and it scares the hell out of me. But I'm like, who do I call about that? You know what I mean? And that was, I think sometimes when Director Chopra was criticized, it was because he would sort of try to verge a little outside of financial services to address these areas. But the impulse behind, like, look, over there, consumers are getting hurt. Over there, the digital economy is not sort of evenly balanced in a way that's going to benefit consumers. Like, I think that impulse is right. I also think the other thing that's interesting about the kind of normative discussion is I do think, and this is something you and I have talked about before, there's not a perfect 100% overlap between what's best for a functioning market and what's best for consumers, at least on an individual basis, right? And we see this a lot with like credit reporting and credit scoring, which was another area, obviously, that the Chopra era CFPB spent a lot of time on. It can be bad for an individual consumer to have derogatory information shared with them through the credit bureaus. But if it's shared well and the data is accurate and the consumer has rights to manage that data and dispute that data if it's inaccurate, there is a benefit to consumers and the market overall of having like cheap, accessible access to credit, which is, facilitated by that. So I do think that with open banking, we haven't yet seen where some of those edges are between the rights to the data that the consumer has, which, as you say, when you frame it in the language of rights, that's one very specific lens, versus what obligations we have to make sure the market functions in an efficient way. So not easy answers, Dan. You're giving me a window into like probably the agonizing conversations and decisions you guys had to have internally when you were at the Bureau.
Yeah, absolutely. And I'll say, we were very lucky. We just had an incredible team working on this. I mean, this is not something that one person or even a couple people can do on their own with any amount of care. This is a really, really challenging policy issue. And so having really thoughtful, career staff folks at the Bureau who think hard about this and who actually understand where all these cracks are is critical for any of this to be successful, no matter what you might think of the CFPB more generally. Right. So I think that's really important to keep in mind.
No, I totally agree. I wish I could say I have more optimism that that sort of really well-staffed team of thoughtful experts, that's going to define the next era of how all this plays out. But it certainly will be interesting. As we've joked about, it's likely that 5 crazy things have happened on this issue as we've been recording and not looking at our phones. But thank you so much for coming on. This was incredibly illuminating, and it's a conversation I've wanted to have for a while.
Yeah, thank you, Alex. Really appreciate it. And it's really fun to be here.